Okay, so today for the project that we're going to be working on here, I'm going to exercise a little bit more of that free form thought. There's been a lot going on recently in the news with the banking industry and different things happening with the FDIC taking over. I've posted a couple videos here and there in regards to SVB, especially if you follow me on social media at all. There's been some posts that I've made there regarding some of the bank failures and the FDIC taking over now that they're insolvent and can't come up with the funds that they need for their depositors. So I think that it's really important that we have a conversation about FDIC insurance. I certainly don't think that this is something that we're at a point where we need to worry about whether or not the banks are going to fail and that we're going to have a repeat of the 2008 financial crisis. There's a lot of different circumstances now versus then. Not to say that something couldn't happen, but in my personal opinion, I don't think that we're at that point yet. But because FDIC insurance, it particularly impacts people, everyday people, no matter how much money you have in the bank, if you are at an FDIC insured institution, this does impact you. And I think that it's something that people need to hear. I don't think that enough people know about certain topics like this regarding finance, where you start to talk about this, the FDIC and what that Federal Deposit Insurance Corporation does and how it affects you as a depositor at these institutions. So I just want to start off with a little disclaimer. This content is for informational purposes only. You should not construe any such information or other materials as legal, tax, investment, financial, or other advice. Any views or opinions expressed in this content are not those of any banking institution and are for informational purposes only. So the first thing that I really want to talk about is, what is the FDIC? The FDIC is an independent agency of the United States government that protects bank depositors, us, against the loss of their insured deposits in the event that an FDIC insured bank or savings association fails. So essentially you have the FDIC, which is backed by the full faith and credit of the United States government. Obviously, if we hit an apocalyptic scenario and the government's failing, then FDIC insurance won't matter, but I'm sure that we'll have much larger problems on our hands at that point if that would be the case. That being said, essentially they are an insurance policy, an insurance provider. So, if you're not familiar with who they are, that's what they do. They do insure deposits that you have at financial institutions. However, you do have to be banking with an FDIC insured partner. There are banks that do not carry FDIC insurance, so it's really important that if you don't know if your bank is FDIC insured, there are resources out there on the web. You can actually look up who is FDIC insured. I'll plug one of the websites later that this information has been pulled from, and it's actually the FDIC's website. And it's a .gov website, so you don't have to worry about whether or not it's commercial or a scam or anything like that. It's information coming directly from an official government website. And again, I'm going to try and avoid the politics. I have a lot of comments and jokes and things that I would normally insert here in these type of situations, just because of the feelings that I have towards a lot of the things that the government does and the policies that they have, but I want to make this more educational, so we're just going to stick to that, and we'll keep that to ourselves for the moment. But so FDIC, so if we're going to look at what is deposit insurance, so I've mentioned that you can insure your deposits through the FDIC. So what is deposit insurance? FDIC deposit insurance protects bank customers in the event that an FDIC insured depository institution fails. You do not need to purchase this insurance. You do not pay for it. It is an automatic coverage that is provided for any deposit account that's opened at an FDIC insured bank. Deposits then are insured up to at least $250,000 per depositor, per FDIC insured bank, per ownership category. Deposit insurance is calculated dollar for dollar, so principal plus any interest accrued or that's due to the depositor through the date of the default. So as an example, if a customer has a CD account, a certificate of deposit account, in her name alone with a principal balance of $195,000 and $3,000 in accrued interest, that full $198,000 would be insured because it is under the $250,000 threshold. So again, if you go back to that $250,000 per depositor, per FDIC insured bank, per ownership category, the easiest way that I can break that down is to say, for example, if you, John Smith, have an account with an FDIC insured bank, a checking account, let's say, and you have under $250,000, you are insured up to that $250,000 mark for that account. If you also have a savings account and it also has under $250,000, that savings account, even though you, John Smith, are the only one who owns that account, it is still covered up to $250,000 in the event that something happens. So essentially what that means is that you have a total of $500,000 in FDIC insurance coverage because the savings and the checking are two different ownership types. So you have the same amount of coverage on either of those. But if you have multiple savings accounts and you have more than 250 between those accounts, you're only covered up to that 250,000 for that ownership type. I know that I am not a person who needs to worry about whether I have that much money, saved in any one account anywhere. I wish that I had to worry about having over $250,000. Unfortunately, that is not the case, and I think that most of my viewers are probably going to be in that same boat. But that being said, maybe you're not. You could be tuning into this and seeing it, and you're trying to figure out how to protect your life savings that, you've accrued over many, many decades. It's not going to help you by just taking, $500,000 and moving it into one savings account because you're only protecting $250,000. It's also not going to help you to have the same bank that's FDIC insured and have two different savings accounts with $250,000 each because, again, it's by ownership type as well. But if you have $250,000 in a checking and you have $250,000 in a savings, you're covered for your $500,000. So I don't want to be too convoluted there, but I feel like it's pretty easy to follow. So I'm going to move on to the next piece. But like I said, I just wanted to get that information out there and try to break that down a little bit so that it's a little bit more understandable and easier to digest. So what happens when a bank fails? So in the event that something like this happens, the FDIC responds in two different capacities. So the first, as the insurer of the deposit accounts, the FDIC will pay insurance to the depositors up to that insurance limit, that $250 per account type, per ownership, per FDIC bank. Historically, that happens within days of a bank closing, usually the next business day. And they're either providing a depositor with a new account at another insured bank in the equal amount to what they had covered, or they're issuing a check to each depositor for the insured balance of their account that's at that failed bank. So in some of the stories that you've seen, I'm sure at this point, where they talked about the FDIC was setting up a new bank essentially to be able to hold the deposits for shuttering the banks that failed. Secondly, the way that the FDIC responds is that as the receiver of the failed bank, the FDIC then assumes the task of selling or collecting the assets of the failed bank. They're going to be settling debts. They're going to be including claims for deposits in excess of the insured limit. If a depositor has uninsured funds above the $250,000 mark, meeting all the criteria that we've discussed, then some of that or all of that may be repaid to you once the FDIC has gone through the selling and collecting of assets. That's also important to understand that while there are coverage limitations to the FDIC insurance that we receive as depositors, there are certain circumstances where you can be insured above and beyond that coverage. That's just the guaranteed level that they permit to the depositors. So again, just to break that down one more time, how much deposit insurance coverage do I qualify for with FDIC? The standard deposit insurance amount is $250,000 per depositor per FDIC insured bank, per ownership category. Is every financial product at a bank covered by the FDIC? No, absolutely not. So FDIC deposit insurance only covers certain types of products. So checking accounts, savings accounts, money market deposit accounts, which is another form of savings, and certificate of deposit, so the CDs that I had mentioned earlier. Those are the types that are covered when it comes to the insurance purposes of the FDIC. One of the important things here to take note of is that if you have investment accounts, for instance, they are not going to be covered by FDIC. So if you are at ABC Bank and you open an investment account with ABC Investments and that bank goes under and the FDIC has to take over, if those holdings are affected through that process, there is no coverage on that. Even though you open the investment account through the financial institution that you bank with, that is not the same thing. There's going to be a different brokerage company that is going to be handling the investment side. So I think that's definitely important too. So just make sure to take note of that. So this is where I'm going to plug that website. There is a lot more information that you can delve into and a lot more questions that can be answered. But I wanted to try and cover some of the basics and some of the most important pieces, of this information. But if you go to, it's the letter fdic.gov. If you go there, there's actually an FAQ section where you can go through, and the actual FDIC provides information that will help you understand anything that you have questions on. Obviously, if there's something I can help you with, you're more than welcome to comment on the video, ask questions. I have no issue with that. As everything here at the Freeform Project, I want to have that discussion. So if there's an opportunity for us to, discuss things, then please think freely and discuss openly, and let's get that conversation rolling. But again, this is just one of those things that I am very passionate about, people understanding how and why the financial world ticks, and what some of the different resources are. And I think that financial literacy is something that is so extremely important. It's often don't learn these skills unless you have someone in your life that understands how compound interest works, and how savings account works, and how stock ownership works, and how investments behave, and what certificates of deposits are. And I just find that there is a high level of ignorance that people do not understand. They don't know. They've never been taught, and it's nobody's fault. They just were never taught how these principles work. Personally, I would say that financial literacy is something that should be taught in every single high school across the country. They should teach you about credit and mortgages and interest rates and all of these things. That's stuff that's basic human need in this day and age. And I think that we are drastically undereducated when it comes to those. So this is probably the first of many different topics that I'll cover. I just wanted to use this as an introductory, being that right now the FDIC is at the forefront of a lot of people's minds. It's unfortunate, but with what's happening in the banking industry right now, it's something that we need to think about, and it's something that we need to discuss. So all of that being said, I just leave you with this thought: think freely, discuss openly.